My name's Julian Sims. I'm with the Department of Management at Birkbeck, and the objective of today is to talk about the basics of accounting, finance and governance. So this module, this Sprint 4, would normally be taught on an MBA to students who have a background with either an undergraduate business degree or many years of experience in management. And some of our students have that on the MBA and some don't. So it's important that we kind of bring everybody up to the same pace. So what we're talking about is accounting, finance and governance. And if we start with accounting, we're talking about a view of organizational activity where we look at the resources and we measure the resources from a financial perspective. Not because we're obsessed with money, but because money is just one way of understanding how we can quantify the resources that we're using. And to quantify those resources, we record transactions, we report on those transactions, and from a governance perspective, we need to make sure that those transactions are recorded and reported in an honest and auditable manner. So there's financial accounting, there's management accounting. Financial accounting is how we report what's going on inside an organization to the stakeholders within that organization, but also to people outside of the organization. So people often say that financial accounting is a view of an organization to the outside stakeholders. So investors, government, users, customers, and employees will all want to know that an organization is being managed fairly and honestly. So in order to do that, we record all of the operations of an organization. Those records are consolidated into reports, and those reports are eventually provided to the world outside in terms of a profit and loss account, which is a view of all of the transactions and activities within the organization, a balance sheet, which is a snapshot at a point in time saying what is the value, what is the worth of that organization, and a cash flow statement which examines how or illustrates how the money flows through the organization. So let's start at the very basic level, which is recording a transaction. Let's take the example of a small company and an entrepreneur. So an entrepreneur sets up, let's say my plumber, sets up a business because he wants a plumbing business and says, okay, I'm going to invest £1,000 in my company. That £1,000 is owed to him, but now belongs to the company. So what we do is we record the payment of £1,000 into that organization. And we have something called a T account, which looks like that. You can see why it's called a T account. And we would call it investment. Okay? So investment in there. And we put £1,000 into it. How we record that, how we put the £1,000 into it is important. So many years ago, actually it was the Moors in North Africa and Spain who developed the concept of double entry bookkeeping. And they developed this idea that every action has an equal and opposite reaction, and every entry in double entry bookkeeping has an equal and opposite entry that balances it. And because it balances, there are no errors, so it becomes auditable. And so we have debits and credits, and every debit has a balancing credit or a group of credits which will balance it. To remember where the debits and the credits go, there's a lovely little mnemonic which I use, because I will often forget this, which is all elephants do like ice cream, which works nicely because even if they don't like ice cream, it's the same. And that's assets and expenses are debits, liabilities and income are credits. Now, I'm not going to go into why they're debits and why they're credits, although I think that's fascinating. I understand that a lot of people think that kind of thing is rather boring. But let's just accept that there are debits and credits. And on the left, we have the debits, and on the right, we have the credits. And our investor, our entrepreneur, has invested £1,000 into the business, and that's now a liability. It's a liability because that is owed to the investor. And so because it's a liability, it's a credit. So we put £1,000 in there, and that £1,000 came in cash, so we put a little note there. But now we also have to open a cash account. So we have a cash account here. We've got debits on that side and credits on that side. And because the £1,000 is an asset is something which has some kind of durable value. So it's a thing or something like money, an abstract concept like money, but it's something which has durable value. And a kind of rule of thumb is if it has a life of more than a year and a residual value at the end of it, then it's probably an asset, okay? Cash has a durable value. I can have cash in my pocket now. If I've still got it tomorrow, it's still probably worth the same amount of money. And so that has some durable value. So because it has durable value, it's an asset. Because it's an asset, it's a debit. So now we put the £1,000 in here in the cash account, and it comes from the investment. So now we have a credit in this account and a debit in that account. So we have a balancing credit in one side and a balancing debit on the other side. And that's the essence of double entry bookkeeping. That is how we record transactions. Okay? Now let's say the plumber wants a van. Okay? He has to keep all of his tools in something and go from job to job. So he buys a van. And the van is going to cost, I don't know what vans cost these days, say £10,000. So we open a new account and we call it a van account, okay? So here we have a van, debits on that side, credits on the other. And the van is an asset. It has a durable life. It has some kind of value at the end of that life. And so it's an asset, so it's a debit. So let's say we have a £10,000 van in there, but we don't have £10,000 to pay for it. So let's say we borrow £10,000, we get 100% financing for it. We borrow £10,000 to buy the van. So now we have a loan. A loan is the opposite of an asset, so it's a credit. So now we have a loan account, credits, debits, and we have a credit here of £10,000. So now we've got a loan and a van. The loan is the opposite of an asset because the loan has durable value. It will exist for more than a year. We have to pay that loan back at some point. It's not transitory. So again, it's about assets and liabilities. The loan is a liability because we have to pay it back. Just as the initial investment or shares is a liability because it belongs to the investor. So the loan is a liability, but we have a credit here and a debit there. Now let's say our plumber goes out and does a job, okay? And so they have a sale. He installs a bathroom, and so we've got sales here. And so the plumber installs a bathroom and gets £3,000 for it. Okay? What's that £3,000? Is it an asset? Well, the cash is an asset, but the sale isn't an asset. The sale is a transitory thing. The sale is an activity. The sale happens, and that's it. We move on. So the sale is income. So the sale is income. So we have a £3,000 sale, and that goes in here. Bathroom. And so now we have a credit of £3,000. Did the customer pay us £3,000? Well, the customer might have paid us £1,000 or £1,500, say, and agrees to pay the balance in a month's time. So now we have cash, which is an asset of £1,500, which is bathroom, okay? But now they owe us £1,500, so that's now a debtor or accounts receivable. So now we open up a debtor's account, and that debtor is an asset because they owe us money. So that debtor is a debit. And here we see that's also from the bathroom. So here we see 1,500, 1,500 balancing that 3,000. So now we're happy. We've got our double entries and they all balance. Okay? Then we can close these off at some point and we can say, okay, what's the state of play right now? We close this off, and don't forget it's got a balance on both sides. Here we've got 2,500, but we've got nothing there, so it doesn't balance. What do? We put in a £2,500 entry there, which is going to be carried forward. Okay, that's a closing balance. Now we have 2,500 on both sides, and this now goes through to the next time period. Okay, so this carries through and is the opening balance for the next time period. When we've closed all of these off and balanced these all out, these closing figures, these closing balances, can then be taken through into our reports. Our assets and liabilities go into our balance sheet, and that shows us at a snapshot in time, when we close all these accounts, what is left, what's the residual value in each of these accounts. For cash, £2,500 would go into the balance sheet as an asset at that point in time. But also these things like sales, which are expenses and income, in the case of sales it's income, they also get closed off. And the balancing figure from these goes through into a profit and loss account, because the profit and loss account is about activities. It's about what's going on, how do we record the process of business within the organization. So here we have sales, which is an income. We could also have expenses. Let's say we have petrol. Okay, so we have a petrol account, and we spend £100 on petrol. Okay, well, £100 on petrol is an expense. Okay, that goes in there. That goes into the van. Okay, but we've got to have a credit over here. So we would put a credit over here of £100 of petrol, which means that this would now become a £2,400 balancing figure. So that, again, it's Debit on one account, credit on the other. They're all balancing accounts. They're all going to, with double entry, they're all going to balance off. This goes into profit and loss. This goes into profit and loss. The debtors, the cash, the investment, the loan, the van, all of these things have durable value, so they all go into a balance sheet. The final account, which we would be, the final report which we would be looking at, would be cash flow. Cash shows how money flows through an organization. And that's very important, because you can be in profit and have now cash and still go bankrupt. Okay, that's an important point, that even if an organization is in profit, if it doesn't have the cash to pay its wages, to pay its bills, it can still go bankrupt. And so the cash flow statement can come just from the cash account, but that doesn't give us an awful lot of information. We can read each of these little notes and these entries and understand where everything relates. But the cash flow account has a particular format, which we'll look at in the next video. And the cash flow account tells us where our money is going. We can analyze it and say, where are the chief sources of cash? Where are the chief sources of problems for acquiring cash? And that cash flow statement is useful to outsiders, it's useful to suppliers to let them know that they're going to actually get paid. It's useful to employees because they want to make sure that they get their wages. Of course, it's useful to the government. The government regulates all of this. The government wants its taxes, and so the government wants to know that an organization will have the cash to pay its taxes. And so we have the balance sheet, which is a snapshot of the value of an organization at a particular point in time. We have the profit and loss, even for a non-profit organization, even for a governmental body. We have a profit and loss which shows all of the activities within that organization, and then we have the cash flow statement, and the cash flow statement shows just what is liquid, just what is negotiable. Okay? And those are the three statements which we're going to look at in the next session.